Welcome to the Deep Dive, where we unpack complex topics to give you the essential insights you need. Today, we're diving into a company that's, well, really at the cutting edge of energy innovation, but also steeped in significant controversy. We're asking if a pre-revenue nuclear startup can truly hold the key to our energy future, especially with this AI revolution, just creating an insatiable demand for power. But here's the kicker. The market seems to be pricing in a revolution before it's even begun, and we're going to explore, just how much risk that really entails.
Exactly. We're talking about Oklo Inc., trading on the NYSE, ticker OKLO. And this deep dive will analyze the company from, well, pretty much all angles. Its business model, the management team, its current financial reality, what the market thinks, the ownership structure, and of course the big one, the risks. Substantial risks. So our mission here is really to look beyond the hype, and understand the underlying value, or maybe the lack thereof. This is as of July 12, 2025, when his share price was $56.07.
Okay, so if you're ready to peel back the layers on a company that could, I suppose, either power our future or turn out to be a financial fallacy, let's unpack this. Before we dive in, just a quick note, remember to like and subscribe to Stock Analytics AI. For just €4.99 a month, members get priority deep dives on specific tickers. And over the next few months, we're covering all of the S&P 500 stocks, and members get that exclusive priority access. If you just want a one-off deep dive on a stock you're interested in, just drop us a super thanks.
Okay, now that we've set the stage for Oklo, let's really get into it and understand their core business. We begin with Chapter 1, Business Analysis. What exactly is Oklo setting out to do? And, how do they actually plan to make money?
Well, what's fascinating here, I think, is that Oklo is going for this build, own, operate model, the BO model, which is quite a big departure from traditional nuclear. See, instead of just selling the reactors, their plan is to own and operate their Aurora powerhouses themselves, and then sell the electricity and heat directly to customers. We're talking long-term deals, multi-decade power purchase agreements, PPAs. Right, PPAs.
Yeah, so this basically turns them into something more like a long-duration infrastructure asset company.
Right.
Like a utility, maybe, rather than just a one-time equipment vendor. What's really interesting is how this model shifts their risk.
Yeah.
From just a sale to a long-term operational thing. It could create sticky revenue, sure, but also means massive capital needed up front.
That is a huge strategic pivot. So tell us more about these Aurora powerhouses. What are they exactly?
So the Aurora Powerhouse, that's their flagship product. The first commercial unit, the plan is for it to produce up to 15 megawatts of electricity. And they've got plans to scale that up later to 50 megawatt, maybe even 75 megawatt. But what's really critical here is that this isn't just some, purely theoretical design on paper. It builds directly on the Experimental Breeder Reactor 2, EBR-2. There was a U.S. government project. It had 30 years of successful operation, over 400 reactor years of operational data behind it.
Wow. Okay. So a lot of history there.
A significant advantage, yeah. It lends credibility to their technical claims. But the challenge, of course, will be scaling that experimental design into something commercially viable. Units you can actually sell power from reliably.
That's fascinating. Building on proven tech? Does that maybe give them a bit of an edge with regulators? And speaking of big challenges, I understand they're also looking at nuclear waste. How does that fit into their strategy?
Precisely. Yeah, a key part of their strategy is commercializing nuclear fuel recycling. They're developing capabilities to convert used nuclear fuel, which, still contains over 95% of its original energy content, convert that into a viable fuel source for their own reactors. This tackles a major industry headache, the waste problem, and it taps into a vast domestic energy resource.
Okay.
If they pull it off, if they can make it work commercially, it could be a powerful differentiator. But look, it's technically complex, highly regulated, and it's definitely not proven yet at commercial scale.
So given all this ambition, where does Oklo actually stand right now? Are they building things yet?
No.
Operational?
Well, as of today, July 12, 2025, Oklo is still pre-revenue development stage. They've got about 120 employees. Yet, and this is the striking part, it boasts an $8.4 billion market cap. Reflects huge investor optimism, obviously. They have secured a site permit at the Idaho National Laboratory. That's a step. They plan for 2 more powerhouses in Ohio, and they've even been selected to provide clean power to Eielson Air Force Base up in Alaska. Plus, they have these non-binding letters of intent with some big names like Equinix, the data center operator, and Diamondback Energy.
That is an impressive pipeline for a company with zero revenue. So what's the biggest hurdle then in turning those non-binding letters into actual contracts, actual revenue? And what's their core pitch to these potential customers?
The biggest hurdle, Unequivocally, it's regulatory approval and then successful construction, no question. Their value proposition, though, is compelling on paper. They offer 5 key pillars: clean, zero-emission power, reliable baseload, over 90% capacity factors, they claim. Affordable, they're targeting 4 cents per kilowatt hour, and capital expenditures under $4,000 per kilowatt electric. Very ambitious.
Very ambitious indeed.
Then fuel recycling, that unique differentiator solving the waste issue. And finally, a turnkey solution, basically taking the capital investment and technical risk off the customer's plate.
Okay.
But yeah, those are incredibly ambitious targets, especially the cost and capex claims. For a pre-revenue company trying to break into an industry known for, well, cost overruns and delays.
Right. Here's where it gets really interesting for me. What does the broader market look like for this advanced nuclear stuff? And who are their main competitors fighting for this space?
Oh, the market is potentially huge, yeah. Driven by decarbonization goals, obviously, but also this exploding energy demand from AI, from data centers. The U.S. alone might need, some estimates say, up to 770 gigawatts of additional clean power by 2050. And advanced nuclear could potentially provide maybe 200 gigawatts of that. Plus, public perception of nuclear seems to be getting, more favorable lately. However, the competitive landscape is definitely getting crowded. Oklo faces rivals like NuScale Power, TerraPower that's backed by Bill Gates, a direct tech competitor in many ways, Andy. Also X-Energy, GE, Hitachi, Kairos Power. They're all vying for a piece of this market, competing on technology, cost, and crucially, speed to market.
That sounds like an incredibly tough regulatory environment, just given the nature of nuclear. What are the key hurdles they face, specifically with the regulators? You mentioned that earlier.
Yeah, the single greatest external factor, no doubt, is the U.S. Nuclear Regulatory Commission, the NRC. Their licensing process is, well, notoriously complex, lengthy, expensive, especially for these advanced non-light water reactors like Oklo's Aurora. They're kind of breaking new ground for the NRC, too. And remember, in a major setback, the NRC actually denied Oklo's initial license application back in January 2022. They cited Oklo's failure to provide sufficient technical information on key safety topics. That was a critical moment, a real blow.
Ouch, so they got denied once already.
They did. But they are re-engaging. The NRC recently accepted their licensed operator topical report for review, so that's progress. Plus, there have been recent executive orders signed by President Trump aimed at streamlining approvals for new nuclear plants. That could potentially benefit Oklo, maybe speed up that notoriously slow regulatory process, but it's still a maybe.
So, given these challenges, the competition, that previous denial, what about Oklo's competitive advantage? Their moat, so to speak. What makes them unique, potentially?
Their potential moat, yeah. It's multifaceted, but look, it's still largely unproven. They do have strong brand recognition, partly thanks to high-profile backers like Sam Altman, Peter Thiel. And they have that first-mover status with the NRC, having been the first advanced reactor developer to submit a combined license application, even though it was denied initially. They claim cost advantages through simplified modular design and that unique fuel recycling capability. But these are still theoretical right now. We haven't seen it built and operated at cost. Their build, own, operate model that's designed to create extremely high switching costs for customers down the line, make it sticky. And finally, they do possess some unique assets that proven EBR2 technology base to build on, strategic government partnerships for their first site, and fuel access at Idaho National Lab, and of course, a portfolio of intellectual property. But again, translating potential into reality is the key.
Okay, so we've laid out this ambitious business plan, but for a company at this stage, the team running the show is absolutely critical. Let's dive into Chapter 2, Management Evaluation. How does Oklo's leadership stack up? Especially, considering that past regulatory setback.
Yeah, management quality is paramount here, absolutely. Oklo was founded by 2 MIT-trained nuclear engineers, Jacob DeWitt's the CEO, Caroline Cochran the COO. So deep technical expertise there. They're complemented by their CFO, R. Craig Bielmeier, who has over 30 years of finance and strategy experience from energy giants, BP mainly. Now, that NRC denial in 2022, that was a crucial test for them. Management publicly said they were surprised, but the NRC statement was pretty clear. Oklo repeatedly failed to provide substantive information.
Right, that discrepancy seems important.
It does raise questions, yeah. Did they misjudge the requirements? Was communication lacking? However, their subsequent actions re-engaging with the NRC, hiring former NRC staff that does suggest a positive adaptation. They seem to be shifting from maybe a research-focused startup mindset to what's needed for a regulated entity. That's a necessary pivot for commercial success.
You mentioned the NRC denial was a crucial test, and management expressed surprise, but the NRC said they repeatedly failed to provide info. How do we square that circle? Does it raise a red flag about their initial approach, maybe their transparency?
It definitely raises questions, yeah. The NRC's stance implies a pretty significant gap in that first application. Suggests maybe they underestimated the regulatory burden or perhaps just weren't fully prepared for that level of scrutiny.
Mhm.
But as I said, their response re-engaging, bringing in former NRC people, it does indicate a learning curve, a commitment to address those shortcomings. The market's going to be watching very, very closely to see if this second attempt is more buttoned up.
Okay. And beyond the NRC issue, have there been other concerns raised about their transparency or ethical standing?
Well, they adhere to the standard public company stuff, SEC filings, investor relations. However, their ethical reputation is under some scrutiny. There was a short seller report in late 2024 that questioned their viability, and that led to a securities fraud investigation being announced by the law firm Pomerantz LLP.
Okay, an investigation.
Yeah. And critics have sometimes labeled them a paper reactor company,
Yeah.
basically saying there's a perceived lack of detailed public engineering schematics compared to some peers. But really, the NRC denial and the stated reason for it, that remains the most significant mark against their transparency so far, suggests a potential gap between the public story and the regulatory nitty-gritty.
So what does a pre-revenue company like Oklo actually do with its capital? How are they allocating funds right now?
Right, good question. As pre-revenue, it's pretty straightforward.
Mhm.
Basically, all funds go into developing the core business. That means primarily R&D, huge expenses there for reactor design, fuel recycling tech, and also significant G&A, general and administrative costs, largely for navigating the regulatory process, corporate overhead. They also made a strategic acquisition back in February 2025, bought a radioisotope producer called Atomic Alchemy. That cost $24.7 million in cash and stock. The idea there is to diversify future revenue streams, maybe create synergies with fuel recycling.
Interesting.
And as you'd expect for a capital-intensive growth company like this, they don't pay a dividend. No history of share buybacks, which is appropriate, right? All capital is being reinvested into the business. Their return on invested capital, ROIC, is deeply negative right now, of course. The entire investment case really hinges on their ability to eventually generate a high sustainable ROIC in the future if they get operational and successful.
That ties perfectly into our next segment. Let's get into the hard numbers then. Chapter 3, Financial Analysis. What do their financials tell us about a company with, again, an $8.4 billion market cap, but absolutely no revenue?
Yeah, the financials reveal a pretty stark profile. It's quite something. That $8.4 billion market cap, it's exceptionally high for a company with literally $0 revenue for the trailing 12 months. Zero. Analysts don't expect meaningful revenue until maybe fiscal year 2027. And even then, the projection is only around $13.33 million.
Tiny compared to the valuation.
Exactly. All profit margins are negative, naturally. Their trailing 12 months EBITDA was negative $63 million. And their most recent quarterly net loss was nearly $10 million. Free cash flow is consistently and increasingly negative. They're burning cash on R&D and operations, which is typical for development stage, sure, but it's definitely a point of concern for investors looking for profitability anytime soon.
So, bleeding cash, how stable is their balance sheet then, despite these losses? Do they have runway?
Actually, despite the losses, their balance sheet looks quite strong in the short term. That's mainly due to recent capital infusions from their SPAC merger, from stock offerings. Their accumulated deficit was about $135 million as of December 2024. That's the hole they've dug so far. But their debt-to-equity ratio is very low. And their current ratio is extremely high, 36.23. That's driven by over $200 million in cash and short-term investments sitting on the books.
Okay, so they have cash.
They have cash, strong liquidity. But importantly, it's capital being held for future deployment, future spending. It's not cash generated from revenue. So basically, they have a war chest, but it's depleting month by month without revenue coming in.
An $8.4 billion market cap for a pre-revenue company.
It's just eye-watering, isn't it?
Yeah.
How does one even begin to make sense of that valuation when there's no revenue, let alone profits? That's the multi-billion-dollar question, right? How do you value a company with no earnings, no revenue? Traditional metrics, like price to earnings, simply not applicable. NA. Their price-to-book ratio, though, is extraordinarily high. 28.73. That indicates the market values them at nearly 29 times their accounting assets. It means the market is pricing in immense value for their technology, their future prospects, their IP. If you compare them to, say, stable utilities that trade at PE ratios around 2022 and they have a positive return on equity, Oklo, with its negative ROE of -56%, well, it's clearly being valued as a high-growth tech venture, a venture with a very binary outcome.
Binary meaning huge success or...
Or significant challenges, potentially failure to deliver on the promise priced in. Either they revolutionize energy or they don't meet these massive expectations.
So traditional metrics are basically useless here. What about a more forward-looking approach, like a discounted cash flow analysis, a DCF?
Well, for a pre-revenue, high-risk company like Oklo, a DCF is really more of an educational tool. It helps you understand what assumptions are already baked into that current market price.
Yeah.
But it's highly sensitive to your assumptions. Things like, when do they actually get first revenue? How aggressively can they deploy reactors? And crucially, what discount rate do you use? It has to be very high to reflect the profound risks involved here.
Okay.
So based on those factors, an educational DCF model, you could plausibly generate an intrinsic value range anywhere from, say, $15 to $80 per share. It's an exceptionally wide range. It doesn't give you a clear buy or sell signal at all, but what it does do is quantify that high-risk, high-reward, very binary nature of the investment.
That $15 to $80 range is incredibly wide. What are the key variables driving such a vast difference, and what does that tell us about the nature of this investment?
Right, the primary drivers for that huge range are, first, their ability to actually bring that first plant online by 2027, like they hope. Second, the pace at which they can then aggressively deploy gigawatts of capacity after that. Is it fast, slow, any hitches? And third, the discount rate you apply. If you assume rapid, flawless execution and maybe use a lower, still high, but lower risk discount rate, you get towards that $80 end. But if you bake in delays, higher costs, more regulatory hurdles, the value drops dramatically down toward $15 or even lower. So this range tells us the investment isn't really about predictable financial outcomes right now. It's much more of a speculative bet on whether they can achieve some very specific, very challenging milestones, pretty much on time and on budget.
It sounds like a company where the market's imagination is definitely running wild, but the numbers are still effectively a blank slate. So let's explore Chapter 4, market sentiment. What's the overall vibe around Oklo in the market? How divided is opinion?
Oh, the market's view is sharply divided. Absolutely. It's a real mix of fervent optimism and deep skepticism. You look at Wall Street analysts, they largely have a buy or strong buy consensus, sometimes as high as 86% recommending it. That's based mostly on the enormous market opportunity, right? The potential. However, their 12-month price targets, they range wildly from a low of maybe $30.30 to a high of $78.75. The average tends to hover around $58, $60.
Yeah.
But that vast dispersion, that huge range in targets, it really highlights the speculative nature. Nobody agrees on what it's worth.
It sounds like a true battleground stock, then. What are the main narratives driving both that fervent optimism on one side and the deep skepticism on the other?
Yeah, battleground is a good word for it. The narrative for optimism is predominantly driven by that AI energy demand tailwind, the idea that data centers desperately need clean, reliable power, and hey, maybe Oklo can provide it.
Right, the AI angle.
It's exactly. Positive news like potential power agreements with the Department of Defense, the Air Force, or those pro-nuclear executive orders from the White House. That's all fueled the optimism. It's led to the stock being described as running on momentum and hype. I mean, it had a meteoric rise over 900% in the past year, despite having 0 operational reactors.
An incredible run.
But then that's balanced by the skepticism, the bear case. That's fueled by coverage of those short seller reports, the securities fraud investigation we mentioned, and also significant insider selling, which we'll get into, all suggesting a deep distrust in the company's current valuation from some corners.
Okay, so you have the technicals maybe showing an uptrend, but then that significant short interest points to a lot of big money betting against it. What does this tell us about the underlying risk and volatility for potential investors here?
Yeah, the technical indicators confirm it's a battleground. Short interest is substantial. Depending on the source, it's ranged from 9.47% to nearly 15% of the publicly traded shares. That indicates a significant chunk of sophisticated investors are actively betting against the stock. It also makes it highly susceptible to a short squeeze, which can just add to the extreme volatility. You get these sharp price movements, up or down.
Right.
Now, as of July 12, 2025, that share price of $56.07, it is comfortably above its 50-day moving average, which was around $47, $49. And it's significantly above its 200-day moving average, around 37 cents. Technically, those are generally bullish signals, confirming a sustained uptrend. But it's an uptrend built on high speculation. So you have this powerful hope trade, driven by the AI energy story, clashing directly with a deep skepticism trade rooted in the company's lack of fundamentals, that massive execution risk. What it means is the price is likely to be driven more by shifts in sentiment, by news flow, than by any steady fundamental progress for a while.
That push and pull between the bulls and bears also makes me wonder, who actually owns Oklo? And are their interests truly aligned with long-term shareholders?
Let's turn to Chapter 5. Ownership structure.
Right, ownership, it's highly concentrated. That's the first thing to note, with significant insider holdings, but also, importantly, some recent insider selling. Institutional ownership is substantial, somewhere between 25.8% and 33%. That includes ETFs, like the Global X Uranium ETFs of thematic investors, and also big active managers like Vanguard and BlackRock. So you've got both thematic and generalist interests there.
You mentioned significant insider selling, including by the CEO, I think. That's often seen as a major red flag, isn't it? Especially for a high-growth story company. How concerning is that here?
It is a key point, and yeah, it's certainly concerning to many observers. Look, the company's co-founders, CEO Jacob DeWitt and COO Caroline Cochran, they remain among the largest individual shareholders. Insiders as a group own a meaningful chunk, about 18.90%. So on paper, that suggests strong alignment, right? Skin in the game.
It's like it. However, back in June 2025, there were several large sales by top insiders. Most notably, CEO Jacob DeWitt sold 300,000 shares. That netted him $16.56 million.
Wow.
Now, look, insiders sell for many reasons: diversification, taxes, buying a house, whatever. But substantial sales, particularly at or near all-time high prices, it can be interpreted as a signal that maybe those with the most intimate knowledge believe the stock might be fully valued or even overvalued, or they're just taking significant profits off the table. It definitely creates a significant conflict in that narrative of insider alignment, especially when the company is still pre-revenue and asking for investor trust.
And with such concentrated ownership, particularly by the founders and early backers, how does that impact corporate governance and maybe alignment with smaller retail shareholders?
Well, the top 7 shareholders, including the founders, they control over 53% of the outstanding shares.
More than half.
Yeah, more than half. So their decisions can have an outsized impact on the company's direction, strategy, everything. Now, concentrated ownership can sometimes ensure stability and a long-term vision. That's the argument. But it also means smaller shareholders have relatively less influence. Their interests are highly dependent on the decisions and the motivations of just a few key individuals.
Okay, so we have a fascinating, maybe slightly concerning ownership structure, but let's be absolutely clear. This is a highly speculative investment. It's time to really face the music on the risks involved. Let's dig into Chapter 6, risk assessment. What are the major internal weaknesses, the external threats, and maybe the broader macroeconomic factors that could derail Oklo's whole journey?
Right, the risks are substantial. Let's maybe break it down using a SWOT framework. Strengths, weaknesses, opportunities, threats. It helps organize it.
Yeah.
Strengths, they do have a solid technology foundation based on that proven EBR2. They have founder-led technical expertise from MIT. They've got that strong balance sheet for now, over $200 million in cash. And they have first-mover brand recognition in the advanced nuclear space.
Okay, some clear strength.
Weaknesses, big ones here. No revenue, no operating history, a negative regulatory track record with that 2022 NRC denial, commercial inexperience in actually building and running plants, and those transparency and ethical concerns we talked about, including that pending securities fraud investigation.
Got it. Weaknesses noted.
Opportunities. The potential upside. Massive AI and data center energy demand. Global decarbonization trends pushing for clean energy, favorable government support, potentially, for nuclear, and the potential to create a whole new fuel recycling market. Significant tailwinds, potentially, threats, intense competition from rivals, some better funded, the existential regulatory risk. What if they get a second NRC license denial? That could be fatal. The broader threat of negative public perception if there's any nuclear accident anywhere in the world. And supply chain bottlenecks, especially for that specific fuel they need, HALEU, high-assay, low-enriched uranium. It just isn't commercially available at scale in the U.S. yet.
That's a really comprehensive list. The NRC denial stands out as a clear weakness. What exactly does commercial inexperience mean in practice for a company trying to build nuclear power plants? And how does that HALEU fuel supply chain issue really impact their plans?
Okay, commercial inexperience basically means they haven't actually built or operated a commercial power plant before, from scratch to operation. This industry demands immense precision, incredibly complex project management, rigorous quality assurance, on a scale very few companies ever achieve successfully. It's a huge leap from design work and R&D to actual large-scale construction, commissioning, and reliable operation. Huge.
Okay.
As for HALU fuel, it's critical because their Aurora reactors are specifically designed to use it. The problem is, as I said, there's currently no large-scale commercial production of HALU in the United States. It's starting, but it's not there yet. This means Oklo is dependent on a supply chain that, frankly, barely exists right now. That creates a major potential bottleneck, significant potential cost overruns, schedule delays, until that supply chain gets properly established.
Right. So beyond these company-specific and industry-specific challenges, what about broader macroeconomic factors, geopolitics? How exposed is Oklo to those?
Oh, highly exposed. As a capital-intensive business planning massive construction projects, Oklo is highly vulnerable to inflation. Inflation could threaten their cost targets, make that ambitious 4 cents per kilowatt-hour goal totally unattainable. Rising interest rates, that would increase the cost of any future debt financing they need for building plants. It also increases the discount rate used in valuation models, which puts downward pressure on their theoretical intrinsic value. And geopolitically, yeah, the global nuclear fuel cycle is very sensitive to tensions. We saw that recently with the U.S. prohibition on Russian uranium imports. Future tariffs, trade disputes, sanctions, they could disrupt their fuel supply chain, even if HALEU production ramps up domestically and significantly increase costs.
You've laid out all these internal, external, macro challenges, but if you had to pinpoint the single greatest threat to Oklo's success, what would it ultimately be?
That's a great question. Connecting all the dots. I think the greatest single threat to Oklo is probably not a fundamental failure of its technology. The underlying physics of the Aurora reactor, based on EBR-2, that's pretty well understood, arguably proven. The real test, the biggest risk, lies in flawless execution. Can they translate that scientific principle into a commercially viable, licensable product? That requires overcoming incredibly complex engineering challenges, supply chain issues, quality assurance hurdles, on-budget construction, and most critically, satisfying every single detailed requirement of the NRC. That 2022 license denial, that was fundamentally an execution failure on that front. They didn't provide what was needed.
Right.
So investment in Oklo today isn't just a bet on the technology working in a lab. It's really a bet on management's ability to execute a multi-billion-dollar, multi-decade, highly regulated, complex infrastructure project. Essentially from a standing start. That's the crux of it.
We have covered a lot of ground today. Very detailed. Let's bring it all together now and synthesize our findings on Oklo Inc. in Chapter 7. Conclusion. What's the ultimate takeaway for our listeners here?
Okay, the takeaway. Oklo Inc. is really a company of extreme contrasts. It presents a compelling story, definitely, but it's also a deeply speculative investment case. The bull case, the optimistic view, it's built on that immense market opportunity for clean, reliable baseload power, especially with AI driving demand through the roof. Their Aurora reactor is based on a proven design legacy. Their build-own-operate model could create stable, recurring revenue with high customer switching costs eventually. And their fuel recycling capability, if it works, offers a solution to waste and maybe a long-term cost advantage. Plus, you have potential political tailwinds and that currently well-capitalized balance sheet. That's the bull story.
Okay, so the bull case is visionary, almost utopian in a way, and the bear case then is grounded in the harsh realities of today.
Exactly. The bear case is grounded in those harsh realities. Oklo carries an astronomical $8.4 billion valuation for a company that is pre-revenue, has consistent losses, and a high cash burn rate. Its entire future hinges on securing regulatory approval from an NRC that has already denied its application once, citing a failure to provide sufficient info.
Can't forget that.
No. This highlights immense execution risk. Compounded by intense competition, those ethical concerns, including the securities fraud investigation, and finally, those recent substantial stock sales by top executives, including the CEO, at very high prices. That raises serious questions about their confidence in the current valuation. Suggests maybe they think it's richly valued right now.
So if their estimated intrinsic value, that educational range, is somewhere between $15 and $80 per share, where does today's price of $56.07 actually sit? And what's the core question an investor should be asking themselves about Oklo right now?
Right, today's price, $56.07. It sits firmly in the upper middle part of that very wide $15 to $80 range. What that positioning indicates is that the market is currently pricing in a highly optimistic scenario. A scenario of near-flawless, rapid execution on pretty much all fronts, regulatory approval, construction, commercial contracts, everything going right. It leaves very little, if any, margin of safety, which is, a foundational principle of value investing. There's no room for error priced in. So for a company like Oklo, I think the ultimate question for you, the listener, to mull over is this. Is the market valuing the revolutionary idea itself, the grand vision, or is it properly valuing the incredibly challenging, uncertain, and expensive path to actually executing on that idea? And how much risk are you truly willing to take when the price appears to have already baked in the revolution before it's even begun?
Food for thought indeed. A very complex picture. Thank you for joining us on this deep dive. If you found this valuable, please remember to like and subscribe to Stock Analytics AI. Members get priority access to deep dives on all S&P 500 stocks for just €4.99 a month. And you can get a one-off deep dive with a super thanks.
And just a final reminder for everyone, this analysis was generated by an AI system. It's for educational purposes only. It should definitely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. We'll be back soon with another deep dive. Until then, stay curious and keep learning.